So what I should say is that we actually managed to win an award from Investment Week for not just really strong performance, but also for the smooth transition of those two mergers. And that was largely done for a number of reasons. It was a combination of performance, consistency of performance, but also for scale benefits to the shareholders. Now, when I think about Scottish Investment Trust, it was more the former, it was around performance, while for JPMorgan Elect, it was more the latter. It was around giving shareholders the benefit of scale. So for JGGI, we're looking for high conviction stocks that control their outcome, that have significant valuation upside, and that we have clear insight into the business and what will make the stock perform. Now, it's the research analyst's responsibility to find the most undervalued stocks among their coverage. The PMs will then collaborate with the analysts, so Helgi Skibelli and Tim Woodhouse alongside myself will work with the research analysts to understand where we have insight into the business and where we have high conviction into the stocks. Once we've found the stocks that offer all three of those characteristics, we don't ask whether or not it can outperform the market, but instead whether it can enhance our portfolio. We believe that's a much higher hurdle rate. Only 2.5% of the stocks that we look at make the final portfolio, making this one of the highest conviction strategies on the market. Yeah, so we absolutely use leverage. We can go anywhere from 5% net cash all the way up to 20% geared. And our framework for that's very similar to how we think about stocks. We think about market valuation, where we are in the earnings cycle, and the amount of dislocation within the market as well. How much opportunity is out there? That'll then largely drive how much gearing we take. And over the last 3 years, we've moved the gearing anywhere from about 1% net cash all the way up to about 10% geared. In terms of the buybacks, now that's largely set by the board rather than the portfolio management team. And again, they're going to focus on when the investment trust trades below a 5% discount to net asset value. And over the last several years, particularly when we had the merger with JPMorgan Elect, the board has been very active in ensuring that they do that buyback, and shareholders should feel confident that the board will continue to do so, and that's been additive to shareholders. So when I think about high conviction, I broadly classify that as a stock has control of its outcome. And it's an important pillar within our stock selection process, because you can have an undervalued company that you have all the insight into, but if the outcome is controlled by its competition or where we are within the economic cycle, that could end up being a poor investment outcome. So among other things, the three things I typically look for is, first, is this a quality business? Does it have high barriers to entry, high barriers to profitability, so that it's not at the mercy of its competition? So if I think about cloud computing, it's an area where you need to do enormous amounts of capital investment and have the software to offer a full suite of services. And for that reason, it's largely controlled by three main players. Second, I think about strong balance sheets and resilient earnings, again, so that it's not at the mercy of the economic cycle. And then finally, does this company have a quality management team that'll act and behave on behalf of shareholders and not destroy capital? For JGGI, we want the stock selection to drive the return of the portfolio. That's our core competence. It's getting the insight from the analysts into the portfolio. We invest across the entire spectrum, from growth to income, from defensives to cyclicals. So whether that's holding names like Microsoft for its cloud computing exposure, whether that's the cyclical recovery within Marriott as consumers move their budgets away from physical goods and into travel and leisure, or whether that's the attractive free cash flow yield and the improving capital discipline coming out of Shell. We're playing into a broad number of attractive themes. And whether you look at the performance over the 1 year, the 3 year, or the 5 year, you'll see that it's the stock selection that's driven our returns. So I think global equity is a great asset class, particularly if you're selective, because the best businesses are scattered all over the world. You need a global lens to find them. You can't find all the best businesses in any single region. So for some of the best software companies, you need to go to the US, while Japan has some of the best industrial, some of the best car manufacturers, while in Europe you can find some of the best luxury retailers and some of the best semiconductor manufacturing equipment providers too. Again, the importance is around staying selective. So for JGGI, we're looking for the best 50 or so ideas across our research platform where we cover 2,500 stocks. So I come back to that hurdle rate of only 2.5% of the stocks that we look at make the final portfolio. But arguably, what's been really attractive to shareholders has been the fact that we've been able to perform over the last 4 years over each of the different style regimes. So whether it's been growth from 2019 to the end of 2021, whether it's been the value regime over 2022, or whether it's the growth regime again over 2023, largely driven by AI, JGGI has been able to deliver strong excess returns over each of these 3 time periods, illustrating that our stock selection has been independent of the style regime we're in. I think that makes us uniquely attractive to shareholders, and that's what's been able to grow share for JP Morgan.